Good evening, everyone, and welcome to this another episode of Your Market Navigator. Markets being where they are and the kind of volatility that we are seeing, I'm sure all our investors and advisors have a lot of questions around the market movement, the opportunities and challenges, and also the economic environment. Today we have our expert speaker, Mr. Neelkanth Mishra, who is Managing Director and Co-Head Asia Pacific Strategy for Credit Suisse. So he will be in conversation with Mahesh Patil and will take us through his perspectives on the challenges and opportunities in the marketplace across multiple dimensions of both economy and markets. Just to kind of give a brief profile of Neelkanth. Neelkanth Mishra is the Managing Director of the India Strategist and Co-Head of Asia Pacific Strategy for Credit Suisse. He has been rated among the best analysts in India by the Institutional Investor and Asia Money polls. He is part of the Advisory Council to the 15th Finance Commission and has been an advisor to committees appointed by the Government of India, such as RNR Committee on GST and FRBM Review Committee. He writes frequently in prominent newspapers and magazines on economic issues. Neelkanth has worked on metals and mining, Indian pharmaceuticals, Taiwan IC design, semiconductor foundries, and Asian tech strategy research. He has been based out of Mumbai, Singapore, and also I think Taiwan. Prior to joining Credit Suisse, he was a senior technical architect with Infosys Technologies. He has also worked with Hindustan Lever Limited and has been an entrepreneur. Neelkanth is also a gold medalist from IIT Kanpur, graduating in computer science and engineering. And he was ranked 4th in the prestigious entrance exam of the IITs. He is currently based out of Mumbai. So welcome, Neelkanth, to this Market Navigator series. And hello, Mahesh, and over to you now.
Thanks, Baldeep, and Neelkanth, welcome to this session. Okay, we had series of discussions over here from internal excellent speakers. It is a pleasure to have you over here. So let's come back. I think in the last 6 months post the COVID crisis has been pretty fast. I mean, you've seen the big crash in the market, things rebound. Economy is at its lowest point, what we've seen in decades. And the key is the virus curve. I mean, how the virus curve has panned out and how it's impacted the economy. So recently, the good news is that we are seeing the new cases in India at least have started to come down. So do you think that the curve is now flattening out in India? And while there are cases about second wave coming up across the world, hear about that, how do you see that trajectory? And would you see things coming back to normalcy soon from Indian perspective?
Yeah, thank you, Mahesh. It is absolutely a privilege, and thank you for inviting me here. It is, I think, much harder to say if the virus and the pandemic itself can be firmly put behind us, because there have been many cases across the world where, without any interventions by policymakers, the virus first spiraled up, then it came down, and when people thought that herd immunity has been hit, it has actually, the cases have started going up again. But what we can say with reasonable surety is that the link between the virus and the economy has actually been broken, in the sense that the economic recovery from now on is likely to have minimal impact from the virus. And the reason I say that is that the fatality rate from the virus has turned out to be significantly lower than what had been feared 6-7 months back. So the case fatality rate has been falling. So incrementally, it's 1.3%. The cumulative number is about 1.5. And if you adjust for the infection to case ratio, so even the ICMR study, which is statistically more rigorous, though of course a whole range of seroprevalence and antibody prevalence studies have shown that the number of infections is actually 25-30 times the number of cases. So if you adjust for that, 1.3% divided by 25, we are talking about one fatality per 2,000 cases. And even though most people would not go into those kind of nuances, the economic participants, but I think everyone has perceived that this is not as fatal a virus and therefore it is no longer affecting economic behavior as much as it used to. And more importantly, I think the governments, municipal, state, and central, have realized that restrictions are not helping. And therefore, I think the economic link has been firmly broken. So as we think about the markets and the economy in the next 12 months, 24 months, 36 months, we should start to put concerns about the virus behind us.
Yeah, so I think that's really heartening to know that. And yeah, so I think we'll have to live with the virus. I think that's going to be there. I think there have been talks about vaccine coming in. I think in US, they're talking about some trials next month. And I think if that's successful, if you see that, then probably people will brush aside and then move forward. It's like, and we've seen the economic data coming in recently. While global economy has reflated back fairly sharply, right? The PMI indices. In India, it's slowly coming back. We've seen the PMI indices going up. Auto sector has bounced back fairly well, though one can argue that it is some pent-up demand and festive buying coming in. But all the indicators are moving up. So how do you see the pace of recovery in India and also in context with how the recovery is happening on the global front? When do you think that we'll come back to the normal level what we had, say, pre-COVID? What's your best estimate of that? I mean, obviously there'll be a few sectors which will reflate faster, but at the broader economic level, where do you see us coming back to the normal level which we had before the COVID crisis?
So, see, the indicators that have done well or are doing very well are now almost every broad-based indicator is now in positive territory, right? So power demand has been positive for several months. E-way bill generation, which is required for GST movements and is a reflection of activity. In the month of October, the daily average is up 18% year on year. Petrol demand has been positive for 2-3 months. Diesel demand, which was down 21% in August, was down 6% in September, and in the first half of October is up 9%. Rail freight is up 18% year on year. So I think the economy on most measures is actually doing far better than had been feared 2-3 months back. The most broad measure, of course, is GDP. Of course, GDP calculation, especially at a quarterly level in India, is more of an art than it is of a science. But I must say that now we are reaching a stage where GDP growth assumptions will be bumped up, meaning the estimates will start rising. So we had seen FY21, so in Jan-Feb, consensus numbers were at 6%. Then as the pandemic hit and the lockdowns were imposed, these numbers went to 0. Progressively, they went to -5, and now they're at -8. There are some people at 10 and -10, -12 as well. My sense is that this -8 will start to move up now, because most people had -3% or so for the December quarter year-on-year growth, and I think that number could be -1 or maybe even 0. And the March quarter number, which a lot of people were at negative, could actually be meaningfully positive. So this is being helped along by the weak base, right? So if you remember, second half last year, auto numbers had started to weaken. We had seen power demand in October down 13% year on year. So this is being helped by that. But what I like to say is, the moment you start talking about base effects, you have already put the virus behind you. So I think there will be scars from this crisis. It would be wrong to say that you can have 6 months of extreme weakness and everything is normal. But I think for the next 12 months or so, the year-on-year numbers will actually look quite benign, which is what I think most markets are anchored at.
But I mean, because the GDP still look, if you look at the full year forecast, still negative, right? And so while depending on the base, you might see the YoY numbers start to look good. But when do you, supposing if 100 was the economic activity level, say at the beginning of this calendar year in Jan, when do we reach that level? Would it be in the first quarter of next fiscal year, second quarter, third quarter? What is your estimate of that?
So the fact that year-on-year numbers start to turn positive by December quarter itself. So I would say that this starts to happen. the month of December. Now, one way of looking at it is trailing 12 months of GDP, right? So that will we cross FY20 level of GDP late in FY22, or will it be early in FY23? That used to be the debate. And my sense is now that on a trailing 12-month basis, we could be crossing that in some time in the second or third quarter of FY22. So I'm talking about trailing 12 months of GDP crossing FY20 levels. But year-on-year numbers are already turning positive, right? So if you're just talking about the pace, I think it is there. I think the bigger issue, and this is something that we need to wake up to, is that the growth in the last 30 years has been 7% CAGR, right? 6.9% something. Let's say round figure 7%. I think that pace may be very hard to get back to very quickly. So while the economy has bounced back because the fear of the virus has receded, and both among regulators and the economic participants, the fact is that scarring from this crisis will remain. So balance sheets have been destroyed. So especially in the informal sector, a lot of sort of retained earnings, which would have become investments for the future cycles, has been destroyed. For especially the bottom 40-50% of consumers, because their income was impacted a lot more than their consumption. They are actually coming out of this crisis with weaker balance sheets. Their ability to invest in basic things like, say, home improvement, etc., I think will get hurt. And therefore, the steady state growth that we were perhaps used to at 7%, and because of the financial crisis, even before the virus, we had kind of started adjusting to a 6% kind of growth. Maybe we are now talking about a 4.5-5% kind of growth. So that is an adjustment which we need to make in our mental models, even though the year-on-year growth turning positive is happening faster than had been earlier anticipated.
So I think what we think that next year probably the growth numbers will look very strong FY22 because of the low base. But beyond that, if you take things normalized and take a 3-year view, you would think that the normal growth rate for India would be around 4.5-5%. Is that what you're trying to say?
Yes. So without any interventions from the government on the financial system side, which would be more reform based, or on fiscal spending. So far we have not seen much of a fiscal response from the government, right? So the government has been very, very conservative in its approach. And in fact, what mostly is the blame put on most governments that it's so easy to spend other people's money, right? Because what the government spend is actually taxpayer money, not just current but future taxpayers as well. This government has been very careful with fiscal spending. If next year they do start to spend on, say, the infrastructure pipeline and start to boost aggregate demand, then of course that 4.5-5 can very easily become 6.5-7, maybe even higher. But without any intervention and without any addressing of the financial system troubles, which we were so worried about before this crisis, right? So if you were having this conversation in Jan-Feb, I'm sure both of us would be worried about the capacity in the financial system, that the PSU banks can't lend, NBFCs, most of them can't grow, bond market is struggling. So if credit growth in the economy aggregate level is going to be single digit, how can nominal GDP growth be 11-12%, right? So that challenge we have to now address, because now the pandemic concerns are gone. We still need to address that. If we don't do any of that, then we are at 4.5-5%.
So I think we've in every crisis there's an opportunity, and the government also is thinking in terms of how do we get back at least to aspiration growth rate of around 6-7%, which is not bad compared to where the global growth will be in the next 5 years or so. So what are the reforms? We've seen some reforms happen in the agri side, right? Which is, we see the rural economy actually is done pretty well in this crisis. Labor reforms, are being talked about. Government is looking at various initiatives to boost manufacturing and more of import substitution. So what are the key reforms which you think which can actually help us to really get to at least around 6% trajectory of growth, what we were tracking, prior to the COVID crisis? And which are the reforms you are more optimistic of, this, since you are also working closely with the policy makers, if you could just throw on a few reforms which you could see can change the growth trajectory from 4 to 5 to 6%.
Yeah, so I think both labor and agri are quite deep and structural reforms. Labor is, I think, most likely to go through, though it is a concurrent subject. State governments have been very supportive. Even non-BJP governments are actually implementing changes, which will mean that the simplification of labor laws and the easing of labor laws is actually quite rapid and broad. The agri reforms are slightly more tricky. You must have seen how the Punjab government is now passed a new law, and that will go to the president for assent. The president refuses and goes to the Supreme Court. Until all of those things are done, I think business will be a bit apprehensive about investing in all the things that we think will happen once the agri reforms are fully done, which is significant investment in warehousing, storage, direct linkages, establishing direct linkages with farmers, and unleashing the potential of Indian agriculture, which is actually very required. But on the labor side, I think the easing is happening, and I think a lot has been done. And over the next 2-3 years, you should see formalization pick up. The veto that that these complex labor laws used to create for foreign investors, I think starts to fade away. The production-linked incentive schemes, I think, are at least the ones that have been announced so far in all detail. The one on handsets and the one on chemicals are, I think, remarkably positive. I think just this could create up to 0.5% of GDP additional in FY25. So I think as these schemes get rolled out to other sectors like apparel, consumer electronics, as you see more action on, say, even automotive components, it is, or even food processing. So I think as these schemes get rolled out, you are likely to see more and more investment, more jobs, and more growth starting to happen. Power distribution reforms have been, I think, considered, and this is something that if you're watching the government from up close, we kind of get used to that. Things get discussed for many years, and then suddenly things start happening. And so power distribution reforms are also, I think, one of those long-standing ones, just like agri and labor. And I think that's very likely to happen. The ones that I would like to see happen are on the financial sector side. So we need to get non-banking finance firms up and running again. And that requires, I think, regulatory intervention, both from the government side and from the RBI side. Because if it is the informal sector, which requires a lot of credit, and credit penetration in India has been a problem, then NBFCs are the best vehicle to drive that. But I wouldn't call it something which is imminent. I think consensus building in policy-making circles takes a while to happen, and it'll be a while before we see some of that. In the interim, I must bring up another factor which I think is a great positive for India, and it is up to us to utilize it, which is our balance of payment surplus, right? Because what we are seeing right now is that the RBI is being forced to intervene in the currency market, and our foreign currency reserves are going up at a pace that we have never seen in history, right? In the last 12 months, the foreign currency reserves have grown at 4% of GDP. And channelizing that, because if you getting some currency reserves, given what happened in 1991 is, I think, required, even in 2013. But once it goes to this level, then it starts to create distortions in the financial markets. And routing these surplus dollars, it's effectively like, in a household, people are sort of giving you money, you spend, and you're saying, no, I'll keep accumulating it. Now, at a macroeconomic level, in the cost of accumulation, what you're doing is you're buying things that yield 0.6% or 0.8%, and especially in dollars, which are steadily falling in value. And you're also paying banks money in the reverse repo market. So I think these excess dollars, if they can be channeled into consumption and government spending, and the balance of payment surplus can be neutered, I think, or at least when brought down, it can provide a significant growth stimulus to India. This is a 6 to 12 month process, I think. So we have already started to see the RBI take measures that the money starts to get rooted into Government of India bonds. For the government to then get comfort and start spending on it, perhaps could be another few months away. This would be the biggest step once it starts to happen about growth.
Sure, and since you external front and the BOP surplus, I mean, do you think this situation can sustain? Because while we've seen currently imports have come down because of the contraction economy, while the invisibles haven't really fallen as much. And also, when government is talking about Atmanirbhar, trying to do Make in India, a lot of import substitution in a lot of consumer items, and looking at view on commodity prices, or oil primarily, you think we are in a comfortable situation forward even as the economy normalizes on the external front?
Yes, no, I think great question. So I see there is a very strong cyclical element. So you're absolutely right that because the developed world has given a large fiscal stimulus, the goods demand in Europe and the US has recovered very sharply. The Chinese economy is already growing at 5%, and our economy has taken a while to grow. Therefore, our exports have revived much faster than our imports, and therefore the current BOP surplus is excessive. No, absolutely. I think there is a strong cyclical element, and which I think should fade in the next 3-4 months. But there are also structural aspects here, right? And we have to think about the fact that if oil stays at $40, that adds about $40 billion. So, say it's a $70 oil becoming $40 oil, it adds $42 billion a year to our savings. And that's a very significant amount. It's like 1.4% of last year's GDP. There are other changes happening though. And it's not just about the Atmanirbharta, right? So it is also the production linked incentive schemes, right? So on the one hand, maybe it's worthwhile taking a step back and thinking about the policy of the last 30 years. See, post 1991, our external account policy was that you keep the current account open, right? So goods and services trade can happen freely, and progressively the import duties are brought down, export restrictions were brought down, and things were freed up. The capital account was kept still controlled, partially open, and it was kind of calibrated, right? So when current account deficit was going up, they would open it up. When it was shrinking, they would again close it, because they were not very comfortable keeping the capital account open to prevent currency volatility. Now, both of these factors have changed, right? So with the production-linked incentive schemes, which will significantly boost our electronics exports. So our assumption is, or at least our estimate is, that in the next 5 years, just on electronics, our external account balance will change by $20 billion, right? That's a significant amount of money, and I'm talking about an annual number. The same could be happening for chemicals, same could be happening for automobiles, or maybe not at the same scale, but directionally the same. And now you are seeing that food exports are starting to pick up as well. So that's on the current account side. On the capital account side, we are opening up our capital account for reasons that have very little to do with access to dollars, right? So the external commercial borrowing requirements have been eased. And we are now starting to see a lot more because our domestic financial system is struggling. We are also seeing special category bonds being issued by the government, which are freely owned by foreigners, or which can be freely owned by foreigners, which could mean $30-35 billion of extra dollars coming in. So in addition to this cyclical element, some excessive stake sale in some company, and some other disinvestment by large infrastructure companies in India. So in addition to that, some real estate investments that are happening. So there are one-offs that you can see. And of course, our imports are subdued and they should pick up. There are also structural elements, lower cost of energy, and a significant amount of capital inflows, in addition to growth in exports. So all of this means that even in the next 12 months, we should have at least a $90 to $100 billion of balance of payment surplus. It is a challenge for the policymakers how to route it to productive spending so that we can sustain our medium-term growth path.
Sure. I mean, it's a good problem to have actually for a emerging market like India. And especially on the external front, confidence to foreign investors, okay, when they are investing, taking a view on the country, that should go well from India from a medium-term perspective also. So coming back on, moving on to the global front, we've seen that there has been financial, overall huge amount of liquidity, low interest rates. So India also, we've seen the policymakers now arguing for a lower interest rate, given the inflation is up. So how long do you think, because with growth also coming back sharply, at least in the near term, how far do you think the easing of financial conditions will sustain globally and in India? Because that's one of the reasons why the markets have also rallied, and the sharp recovery what we have seen in the markets, and also to some extent justifying the higher valuations. Okay, in an environment of low interest rates is what is supporting the markets. So, what's your view on interest rates and liquidity? How long do you think that can continue in the current scenario?
So again, great question. So see, let's split it up into domestic and foreign situation. So globally, I think the central banks have signaled very strongly, and the strongest. I mean, they've been giving forward guidance, which has been quite strong. That and their intent to even intervene in corporate bond markets shows that if there is at all a problem, they are going to step in. And the commitment to lower interest rates is a very strong one. Now, you will see bond markets, like say in the US, already the bond yields have picked up a bit. So 0.6 has become 0.8. For bond traders, of course, 0.8 going to 1.2 will mean a lot. But given where we were 1 year back with bond yields at 2%, this is still a very low interest rate scenario, right? And so globally, our view is that interest rates remain weak. The capital flows may not be as uniformly distributed across all emerging markets as they have been in the past for various reasons. But I do think that a large part of the capital flows coming into India have been foreign direct investment, and which, because of India's growth differential that you mentioned early on in our conversation, I think FDI will keep flowing in. And so long as there is external commercial borrowing, and this was actually being restricted by the RBI, and now it's been opened up, I think more and more dollar bonds will be. So I think capital access to India should not really be that big an issue. The domestic liquidity condition is kind of out of control of the RBI right now, right? This is the classic impossible trinity. That if your capital account is open, which it is now, it's partially open, but sufficiently open to create this impossible trinity. Then, if you want to keep your currency stable, you lose control of monetary policy, right? So if they want to prevent the rupee from appreciation, which is what I would advise, given that most of our capital or currency accumulation, reserve accumulation, is because of capital inflows. So it is prudent to sort of intervene and not let the rupee appreciate too much. So if they keep doing that, there'll be, if you think about $100 billion surplus, we're talking about 7.5 trillion rupees of base money being injected into the economy. Even if the money multiplier is shrinking, if the incremental money multiplier is even 2, we're talking about 15 trillion rupees of additional money coming in. And this is, I think, already far more than what the RBI has been comfortable doing. So if you see the M3 growth, right? So the broad money growth from 2015-16 to 2000, way before demonetization, from 15-16 to late 2019 calendar year, it was running well below nominal GDP growth. In the last 8-9 months, it is running at 12-13%. So the liquidity remaining in surplus is a reflection of the balance of payment surplus and the RBI losing control of that process because it wants to keep the rupee stable. So I think the domestic liquidity is likely to stay in surplus, and which is what I was saying, that if it stays in so much surplus, it creates financial market bubbles, it creates other kinds of financial asset bubbles, which of course are very enjoyable when they form, but when they burst, then they can be quite damaging. So a much healthier way to deal with the balance of payment surplus is to somehow boost domestic demand in a constructive way. But I think the domestic liquidity conditions will remain quite benign for quite a while.
So in that context, liquidity has one of the reasons why we've seen the multiples fairly high. But how do you see the market valuations now? Do you think market is expensive, or is it not? If you take a slightly medium to longer term view and look at where the growth would be and how earnings could move up, how would you? One is the global market, but I would say Indian markets. How would you put them in terms of your framework of looking at it in terms of a valuation perspective? And also, I think probably we need to first talk about earnings growth before we move to valuation. So I would first ask you to talk about how do you see the earnings growth? Because last 4 years actually, even before the COVID crisis, we've seen earnings have been fairly tepid. They've been growing below the nominal GDP growth, right? And long term, we've seen there's at least earnings grow in line with the nominal GDP growth. And there were various reasons for that, right? We had various problems, GST, demonetization, banking, finance, NBFC crisis. So moving on from here, how would you look at earnings, say, for this year, next year, and then move on to the market valuations? How do you see them in that context?
I agree. I think that is a better sequence to think through. So on earnings, see, August was the first month where the 12-month forward EPS started moving up, right? The first month this year when the 12-month forward. So because the forward EPS is a combination of the specific earnings for FY21 and 22 and a roll forward, right? So given that FY22 is currently at plus 42% year on year, every month you gain 3%. So unless you are seeing a 3% cut in earnings, as you start to go forward now, you are likely to see a higher forward EPS. In fact, August and September were the first months where the market performance was driven by gains in forward EPS rather than forward PE, right? So forward PE is already quite high, but my sense is that I think it will start to correct now because the earnings will catch up. Now, interestingly, September was also the first month where FY22 earnings were revised up. So we saw upgrades to IT, we saw upgrades to metals, we saw upgrades to consumer discretionary, and only telecom saw some cuts. But it was a very minor increase, but given how bad things have been, that was very heartening. It's an inflection point. And I think that now numbers will start going up. And I'm talking about the absolute number for FY22. As I said, the growth numbers are now improving. And as that happens, together with the roll forward, the pace at which the forward PE corrects, because the forward EPS is going up much faster, is quite substantial. So I think so we need to keep in mind that at least for the next 3-4 months, we are likely to see upgrades to FY22 earnings. And
that's
I think
a sweet spot because we haven't seen that for a long time. We've always seen earnings getting downgraded now, at least for the last 3 years, 4 years, and that's been the cycle, right? So correct. So I absolutely, and I think look at what's happened to banks, right? I think people have been, because of the significant uncertainty about how the losses will be allocated. See, so maybe the 10% GDP loss this year won't happen. Maybe it is 6%. That's still 12 trillion rupees, right?
if you've lost 12 trillion rupees of income, who is going to bear the pain? Who's going to bear the loss? Some of it is, of course, the government, because the fiscal balance has become worse, and the government borrows more, socializes the losses. But if you look at the implied book value change, because the price to book for the banks, both PSU and private, has corrected. There's been at one point, of course, this number would be changing now. But at one point, the banks were implying a 3 trillion rupee, 3 lakh crore cut in book value, right? And that's excessive, because that is not the quantum of loss that will kind of percolate through to the banks. So as those numbers are revised back up, right? So I think most banks analysts have assumed a certain level of provisioning. And one of the reasons why, at least in FY 16-17, when the earnings growth didn't happen, was brutal cuts to bank earnings. So I think what we are going to see now is that, and credit growth assumptions will now have to be bumped up, right? Because at least for the banks that can lend, especially the private banks, as the economy now starts to revive, I think credit growth assumptions will have to go up. So I think this plus consumer discretionary, I think we should see a fair bit of earnings improvement, especially as metals prices are also holding up. What does that show about PE and valuations? Now, see, there are 3 ways of looking at valuations, right? Valuations are never an absolute term, right? Because it's always in a context. And so the one comparison is to the market's own history. The second comparison is to other assets, other financial assets, because if you don't put in equity, you have to put somewhere else. And the third is versus global equities. And I think on all 3 measures, the market doesn't look very expensive to me. So on forward PE, of course, the numbers are, if you just look at the forward PE, it looks really excessive, right? But then you build in the plus 42% for FY22, and the excessiveness then disappears. So if you assume that FY22 earnings are going to get delivered, even if, say, a 25% growth gets delivered, then the market doesn't look that expensive.
What's your assumption for FY21? Where the earnings growth you're looking for FY21? That will set the base. The base will set the growth rate for 22.
So, and I think, so far we haven't seen upgrades to FY21. So we are at, I think, about a flattish kind of number, plus 4% or something like that. Even in September, we haven't seen, people raising those numbers yet, right? But it is quite possible that, especially the kind of results we are seeing in the September quarter, and the commentary that we are hearing from corporates, it is quite possible that even those numbers can get bumped up. But this is going to be an FY22 story. But you're right that the growth is on 21 days.
If you just look back, and I'm sorry to interrupt over here, but just to get the numbers perspective right. If you would have known that the GDP is going to contract by 7-8% this fiscal year, one would have thought that the earnings decline, because of the operating, it would have been much bigger. But we are staring at a number of more flattish growth in FY21, which is looks very, very. Can you unravel that? What's?
Oh yeah, absolutely. I think that's a great question, and I think this is the biggest conundrum. And most people link GDP growth to earnings growth, and in India, I guess it holds true for many other markets as well. But we are focused on India, so let's think about India. See, there is absolutely no connection between GDP growth and earnings growth in India, right? And there are many prisms through which you can explain that. The first is that more than 50%, actually it's 56% or so, the last we checked, of BSE 100 revenues are not linked to India, right? So they are, large global automakers somehow listed in India. There are, of course, IT firms, pharma firms, even domestic auto firms have a reasonable export mix. And there are metal companies, refining companies. All of this business is actually linked to, what's happening in China or the globe, or the world. And the second is that even in the financial system, which is actually all domestic or nearly all domestic, the PSU banks are a much smaller part of the market than the private banks, right? And the private banks, come what may, keep growing at 15%, right? So, and especially some of the banks, but say even the corporate private banks are still growing at 4, 5, 6%. Even in the midst of this pandemic, and as the system credit growth starts to pick up, it is possible that they go back to 9-10% loan growth. So once you factor in these kind of changes, you realize, and plus then if you think about say things like telecom, right? So what happens to telecom earnings has very little to do with what's happening in GDP, but it's 2-3% of index earnings. And the fact that formalization is also another factor, right? So in this whole process, the informal sector has been hurt a lot more than the formal sector, right? Because they are much more reliant on internal financing, right? So savings from their business for a year are the investment for the next year, and because they don't have access to formal financing. So because of all this, the link between GDP growth and earnings growth in India, actually it's true for China, it's for Korea for different reasons, but these are the reasons why this doesn't apply in India. So I think the earnings are going to hold up. The P multiple as well, coming back to that point, I think the equity risk premium, given the prevailing low interest rates globally, is not excessively low, right? As you know, the equity risk premium, if it is very high, then the stocks are attractive. It's very low, then stocks are expensive. So it is actually not very low. It has been kind of range bound. So it is not that equities relative to other financial assets are looking very expensive. Now, there are many global risks that, of course, people are worried about, and very rightfully so, and very correctly so, that they can be depending on geopolitical conflicts. There can be lots of disruption that can happen. Equity risk premium then can go significantly higher. So all of those geopolitical risks and war risks, etc. I think those
are always there. You've seen that.
Exactly. Correct. But other than that, compared to the last decade, I don't think equity risk premium is particularly low. And compared to global equities also. So that was the third comparison I was talking about. Compared to global equities, emerging market equities, if you look at the PE premium, say versus world global equities, India's PE premium, the 12-month forward PE premium, trends between -8-9%, or has in the last decade, in the last 10 years, has been between -8-9% to +32-33%. It's currently, the last I saw, was at about 12% or so. So it's not either excessively low or excessively high. It's somewhere in the middle, right? So I don't find equities to be at an aggregate level to be particularly expensive. Now, and I know, and I think all of your investors know as well, is that no one buys the BSE 100, right? So people buy stocks. And so there are stocks which are unduly expensive. There are stocks which I think are unduly cheap, and that's where the opportunity lies.
Sure. So for an investor, that's a key question investors and our distributors are trying to convince, because with the market having bounced back so sharply at these levels, whether it's a good time to invest now, and that depends on what your return expectations are from the market, say from a next 3-year perspective. That's at least investment horizon investor would take. In the short term, you could see a correction. Markets can be volatile. There are enough risks around the corner. But if I take a 3-year view, okay, and that's a period where you would see, normalization setting in, what kind of a return you think equities can deliver based on your assessment of the growth and the valuations where they are currently?
So over the next, I would say 3 to 5 years, which I think is a safe horizon to take. I would say that the PE multiple, of course, the forward PE needs to correct and will correct, but we also have a plus 42% in FY22 to adjust for that. But beyond that, I think low to mid-teens kind of returns should be expected, right? Given the structure of the market and what we think index EPS growth should be. So I would say 12 to 14% kind of earnings growth, and once the plus 42% is factored in, then the PE multiple also kind of normalizes that level, and then that should be the assumption that we should work with. But as you know, at every step this has to be calibrated. So if we find that the government steps in and undertakes the necessary reform and measures in the financial system, the collective policy-making apparatus figures out a way to absorb the balance of payment surplus, production-linked incentive schemes turn out to be much more positive than we currently assume. So if all of those things start to happen, then those numbers go up. If on the other hand we create new crises, the fatality rate in the virus turns out to be, or some mutation happens, and just like what happened in the multiple waves in the Spanish flu, so then those numbers can actually come down as well. But as of now, as is, all things unchanged, I would talk about it 12-14% kind of return.
Right. And from a near-term perspective, what's your view on the market, and what is one thing investors should be aware of? I mean, we are getting into, again, US elections next month. Would that be an event you think needs to be aware? Because now there is, at least the initial polls are suggesting the change in leadership in the US. Would that have any impact on global policies and in turn the markets? And what's
I think it is a deeply divisive election, and as we're all discovering, the US election system, the fact that elections in Bihar are happening at the same time, that there are lots of ways in which indecision and problems can be created. And for all you know, we may not even have a result on the 4th, right? So 4th of November. And that prolonged uncertainty and what it means for, the fiscal cliff in the US, because a lot of the fiscal stimulus is expiring. So that will create, I think, short-lived volatility. But I think as regards the China policy, so on the fiscal side, of course, the nature of the policies that the two administrations promise. So both promise fiscal stimulus. From our perspective, in terms of global demand, I think that is going to be fine. From a US stock market perspective, of course, the Biden administration's tax policies are not going to be that positive. So that may create some issues there, but I don't think those issues need to really come down to us. But yes, I think uncertainty will be elevated. I think that much is a given. A bigger uncertainty that I am looking out for, the political one, I think will settle down in a couple of weeks, is inflation. Because you see the way inflation plays out, because the one thing that this Goldilocks scenario, right, where equities keep doing well and interest rates remain low and the Fed, keeps buying all kinds of assets, is something that is not going to change till inflation starts to force the hand of the central banks. And inflation is going to go up, right? So because right now demand is going up and there are supply constraints globally. So at least for some products, even simple things like laptops, the manufacturers are saying that they can only meet 30-40% of the demand. So there can be some inflation, and then suddenly the markets will start extrapolating it as, oh my God, now sell the hell out of bonds, and now interest rates are all going up. But I think that is going to be a temporary phenomenon, right? So the deeper inflation trends will only happen once policy shifts happen, right? So as labor share of income in the US starts to pick up, that's a longer term concern, and let's see if the policies show that up. But if the inflation numbers in the US in particular start moving up in the next 3-4 months, we could see a lot of financial market volatility. And that's something to be on guard for. As of now, that I think even if that happens, it will be short-lived. But that's something I'm more worried about than the political risk. Sorry, Mahesh, you're on mute.
Yeah, no, do you think that the policymakers and that's what the Fed, they would like to keep inflation is there, but for the time being, I think they will not be worried about that. And look how, because the underlying growth is coming back how strongly before they react, right? So
correct. So they do have a dual mandate. So you're right. In fact, unlike our MPC, they do have an employment as well as inflation mandate. And the employment data is looking very patchy already, right? So the unemployment claims, the job creation, all of that, the very sharp revival that we saw is already starting to fade. So I think that is definitely something that we'll keep in mind. But see, from the market's perspective, and it is going to be, you see, sometimes the markets can kind of preempt or rather front run the Fed in the sense that if say inflation prints come out positive and higher than expected for 2 months or 3 months, you see the leverage in the 10-year bond is very high, right? The duration and therefore the bondholder will start to panic that is this the end of the dollar, and so all kinds of fears can start coming up. You're absolutely right. The Fed is preempting that, and their change of guidance and saying that we will look at average inflation instead of point inflation targets and all that is meant to subdue this kind of volatility. But I don't think you can totally wish it away. So that's something that we need to be on the guard for. But I'm also clear that if it happens, it will be short-lived. At this stage, this inflation is not something to worry about.
So I mean, while the market outlook from a long-term perspective looks good, but also want to really create alpha through taking the right sector calls, right? Which are the broader trends you see? We have seen various themes play out in the last decade or so. But going forward from here, which are the themes or sectors where you think can actually do well, and being overweight on that would actually lead to get a outperformance?
So that's what I said, that there are sectors in India which in our market which are very poorly priced. Meaning poorly priced can be interpreted both ways. So where the PB multiple has corrected a lot, and so they are banks and utilities. Now utilities, I think there are a different range of issues with utilities. So we burnt our hands a bit on that. I mean, they were very cheap, and execution has been good, and yet the multiples keep falling. And there are ESG concerns, but those are more forward-looking ESG concerns, because fund managers are afraid that if they buy something and their fund then suddenly changes their rating or says let's get out of ESG stock, will be forced to dump it at a short notice. So which is why some utilities are have halved despite delivering good returns. And so some of those I think make sense from a cash yield perspective. We should buy them not to get appreciation, thinking that if something is at 11% free cash flow yield, then the stock's going to double, and that's not, I think, unlikely to happen. But I think the cash distribution will keep happening, so they will still deliver 8, 9, 10% kind of yield, and I think that should be sufficient. But the stronger call is on the banks, and I think that the market fear on how much of NPAs the banks need to book is excessive. We are already seeing some bounce back in bank stocks because the commentary. So as if companies come out and say, "Oh, sales are much better," if on industry bodies conference calls that's what I hear, people are worried more about supply than demand, right? So everyone is worried that I'm not getting this component, instead of worried about my products not selling. So then I think the problem of NPAs in banks is going to be that much lower. And as credit growth starts to pick up, I think that bank stocks which have significantly underperformed in the last 6 months, the rest of the market, I think would be our strongest bet. They are also, I must say, see, unlike many other markets where the tech sector is disrupting the financial system, because the financial system was slow to change. Many of our banks are effectively like tech platforms, and they are extremely well managed. The private sector banks, in particular, are their quality of management is not very different from, say, a FMCG company. So, of course, there are problems. I think they have created problems for themselves because of business cycles or herd in lending, etc. But I think the price to book multiples at which some of them, even some of the larger PSU banks, I think provide good value over the next 12, 24 months.
So, I mean, banking is a large part of it. It's very important that they do well for the market to really come back. And I think there also probably, if you agree, you'll see a lot of differentiation there, right? Again, the better ones, the better banks, larger banks, well managed, who are more of the technology front, I think will gain market share and further consolidate, right? I mean, that's it, right? We'll see both on the banks as well as on the NBFC space, which is already happening, and it'll only accelerate, I guess.
Correct.
Besides that, which are the other sectors or key?
Yeah. So another thing that we think is a good opportunity at this stage is sectors focused on higher income consumption. See, the mindset of most people in the markets and in the economy, and possibly even the government and regulators, is that we have lost so much of GDP, and therefore there are scars in the economy, right? But the way I look at it is that it didn't consume, right? So it at an aggregate level, and this is the number that we had done, taking a ballpark estimate of 20 trillion rupees of GDP loss. We found that about half of it was to be borne by the government, and about 1/4, 5 trillion, was to be borne by wage earners. And what we found was that because of the lockdowns and the activity restrictions, what was restricted was the consumption of the rich and income of the poor, right? So basically, when you restrict services, services are almost by definition, of course, there are legal services and medical services which are high skilled, but they're very small. In general, service consumption is where you are buying someone's time, right? So as services were restricted, it was the income of the poor, of the rich, and income of the poor and consumption of the rich was affected. So the upper income segments are exiting this crisis or this pandemic with a lot of financial savings and a lot of reallocation of those savings. So, if people are not taking their foreign trips and foreign travel, then there is that much more space for them to buy that extra, bigger refrigerator, paint their house even a bit more. So upper income consumption, so like, car demand, premium two-wheeler demand, and say even among FMCG products, so that's a segment, that's a set of stocks that I think will hold up better. The second segment we should focus on is on formalization. See, this is a process which more or less started in 2016, right? So with demonetization, and then we had GST. And now, while it was not the intended, that was not the reason why the lockdown was done, but this is the impact that the lockdown has had. That you have seen so as I said, that 20 trillion, so we found 50% was government, 1/4 was the wage earners, and 1/4 was to go to the corporates, the businesses. Now, a large part of that actually goes to the informal businesses. The formal businesses, by and large, and that's another aspect, I must go back to the answer I gave you on earnings and GDP linkage. See, we may think that a 500 crore company is a small one, right? Because we are used to dealing with companies now that have market caps of 10 lakh crores. But compared to an average Indian company, that's a gigantic gargantuan company, right? And what we saw in the June quarter, and I think September quarter we'll see how the results are still flowing in that direction, is that revenues fell by 30%, but earnings also fell by 30%. So there was almost no operating leverage. And the raw material costs, COGS for many of these companies fell by 45-50%. So basically the pain was passed on to small companies. And this is what generally would happen in a jungle, right? If there's a shortage of water, the big animals get to drink first, which is another reason why the BSE 500 earnings have been kind of disjointed from GDP growth. Now, coming back to this point, so I think the process of formalization, because the informal sector, the smaller firms are going to struggle. I think this is another process. So there are, firms across sectors where I think this trend can actually play out.
Okay. Just real estate is a pretty large sector and contributes significantly to the economy and that's been also one of pain point in the last few years. How do you, any view on that? Are you seeing any trends over there turn around over here? Because you see interest rates come down, mortgage rates are now at 7% and below. But are the other indicators or other enablers also getting in place? And what's your view on that sector?
Yeah, so let's split the real estate and housing market into two. The one is the self-built housing. So as you can imagine, most people outside the top 30, 40 cities build their own houses, right? So that market has been doing okay. And which is why cement demand is held up, which is why paints demand is held up, despite all the pain that we are seeing in the formalized, organized real estate market. I think in the organized real estate sector, I think the process of consolidation is definitely helping the bigger players. The drop in interest rates and the fact that the stock market also on property look reasonably priced for a lot of people, though I still think that we'll deliver decent returns, means that money and surplus savings can start moving again towards real estate. So we are, and especially as there seems to be this desire to get into only finished real estate, right? So I do think that I think that's a sector which will be a beneficiary of some of the policies of the central and state governments, as well as lower interest rates, and especially as the few firms that we can invest in, some of them are actually consolidators. The one caution I would throw in there is that real estate, we rarely have, other than say maybe some real estate investment trusts, we rarely have national players, right? So it's always about micro markets. Until we have done work on the specific micro markets that a firm is operating in, it is going to be hard. So just as a theme, yes, that's an area to fish in. Should we buy every real estate stock? I don't think. I think not right now.
I'm just looking at the as a sector, revival of the sector really to support the economy, right? Because that's one of the pillars. So do you think that is likely to happen, or?
Yes.
Yeah?
I do think that I think demand. So already I hear anecdotally that prices are at pre-COVID levels. So the prices which had crashed very badly are already starting to revive. It could be area specific, and which is why anecdotes can be sometimes very tricky. But when I look at registration data in Mumbai, registration data in many other cities, they're actually picking up very nicely. So the volume is picking up. The state governments are giving the stamp duty cuts, etc., which they were reluctant to give earlier. But now they realize the importance of the sector for their states, and they are starting to do that. And so I think the policy remains supportive, interest rates remain supportive, and it is quite. So I think as a sector, it can provide some decent returns, especially if you get into the stocks which are actually the consolidators, right? So the number of companies is going to keep shrinking.
And this, between the pre-COVID world and the post-COVID world, do you see any change over there? And that change also is providing opportunities for a few companies or few sectors, okay, which could be some of the themes to play out, or it will be. Do you think it will be business as usual, okay, once we return back to normalcy, or there will be some permanent changes we see coming out of this crisis? and that provides opportunity for a few sectors or a few companies. Anything you're seeing from that?
Yeah, so I think the changes are many. I think these are
more sustainable, right? Which are likely to be more sustainable.
Yeah. So the acceptance of work from home, the acceptance of being work, the two colleagues of mine who work with me, one on India strategy, one on Asia strategy, both of them are not in Mumbai, and I've never felt, and they've been working out of their hometowns for the last 6 months. It has made no difference to me. The same, I think IT firms are also talking about the same thing. So I think the ability to cut costs, and that's one of the reasons why actually we did not discuss IT. So IT services, I think, are going to be a big beneficiary of this, right? So the willingness and ability to deliver services cross border, and unlike goods, which you can actually put duties on and which you can stop from being used. Now H-1B visas, I don't think, they're important, but they're not very critical. I think IT in particular, I think the fact that they can actually shave costs, they can actually provide more services. I think all of those make that sector in particular, I think, one of the bigger beneficiary. There are many others, but I know finding stock ideas for them has been a pain. You can say that, yes, the awareness of cleanliness, immunity booster, this, that, a further step up for natural products. But those are fads, right? So in 6 months, 12 months, they can actually fade again. But I think the proof of a concept in work from home, of delivering large projects when people are working in different offices, I think that evidence is going to be lasting. Right? I don't think people are going to go back to that kind of growth again.
Okay, I think we've running out of time. I'll have one last question. Constant debate about value and growth, right? So we've seen quality or value, whatever you may call it, quality or growth. The last 7-8 years, we've seen quality growth continue to do well, and value has underperformed. And there's a big divergence. As you rightly said, there are certain pockets of the market where there is deep value, and other pockets which are trading at valuations which are probably 1-2 standard deviations above the long-term averages. So do you see any, and in the, I think we think quality will continue to do well, or value could start to outperform? Any views on that? Or any reason to believe that what we've seen in the last 7-8 years could change or will continue? The growth style will continue to do well.
Right. So, I think that is the most important question, right? So, when you have such sharp valuation divergence, obviously, and we are all trained to buy low, sell high, kind of. That's the only way to trade, I guess. But the point is, if something is trading at 30 times earnings, you naturally feel afraid buying it, right? So, the way I think about it is through a slightly different prism. Why is a stock a so-called value stock, right? So if it is a thermal power producer, why is, or if it's a coal miner, why is the stock trading at the level it is, right? And is that reason going to change? So if people are afraid, as I said earlier, that, right now this thermal power plant or thermal power producer is not in the ESG blacklist, but what if it suddenly hits the blacklist and 6 months later I'm forced to sell it? Or if it's a large Indian capital goods company or a construction company which has some defense exposure, and then suddenly someone comes and some fund manager is asked by an asset allocators, which is a global, who says, why do you have defense exposure in your firm? And then suddenly and when they can't explain, they take out money. So people say, I don't even want to touch this, right? So if those are the reasons why some of the stocks are so-called value stocks, I don't think that's changing, right? So we have to think of our expectations from them. As I said, if some of these value stocks are now giving 10-12% free cash flow yield, then I think it is worth just playing them for the yield, not for returns on absolute gains. But otherwise, I think just buying a stock which is because it is cheap and it's a good company there is a reason it was cheap. Until that reason changes, so this momentum, this divergence, I don't think is going to narrow anytime soon.
No, I think we would have loved to talk more. I think there are various other things which we can discuss, but I think in constraint of time, I think we'll have to halt here. So thanks, Neelkanth. It was a pleasure talking to you. I think we've covered various facets, okay, and your insights were really useful. Let me try to summarize for our viewers over here. I mean, what you said was, in the pandemic, I think concerns are behind us. I think the economy is likely to recover. Okay, we already seen that much faster. Globally, also we have seen a good inflation back, and indications are that you should see growth coming back normal. We already seen that in a few sectors, but it should happen in a couple of quarters. Also, the impact on earnings, corporate earnings, is also not as big as what one would have expected in such a sharp decline in GDP in this fiscal year. And next year, could see a sharp improvement in earnings. And in that context, the valuations, while they look expensive from the earnings perspective, are really not that expensive, right? If you look at in context, absolute valuations, or also in context with the global, I think, and that makes it sense for investors. I mean, we've seen a lot of redemptions in the market in the last 2-3 months, right? As the market has rallied and investors have taken out money because they thought that it's a good opportunity to take some profit because the markets have gone up by more than 50%, okay, from the lows. But I think from here on also, I think from our conversation, it looks like the way the growth will likely to shape up, even if it is going to be tad below than the long-term growth rate of around 6% or so. I think overall growth, okay, for corporate India, consider the fact that the earnings have remained depressed now, could be much higher, and the market returns could be in the low teens, which is a good return to expect in an environment where, if you look at where the interest rates are, so it provides enough market risk premium, okay, for one to be positive on equity from a 3 to 5 year perspective. Obviously, there are risks and challenges which are there from a near-term perspective, but should not really bother much. And I think on what you mentioned in terms of the external front, I think we are coming in a situation where the macro for India is looking better than what it was earlier, and that's very important because valuation is one part, but if the macro is good, then the markets tend to do better and can also justify slightly higher multiples. The macro in terms of the forex side, in terms of current account surplus, I think that situation can remain fairly comfortable even going forward. So that's again comforting from foreign investors' perspective. And in terms of the themes, I think I think we're also in agreement with that. I mean, while IT, pharma has done well in the last 1 year and will continue to do well, but I think some of the cyclical players and banking and financials, which has been one of the underperformers, okay, in the last 9 months, can actually come back, and looks like that could probably drive the market outperformance from here on. So I think that's what I think our key takeaways are from this conversation. Thank you, Neelkanth, once again, and thank you all for being on this call.
Thank you, Mahesh.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.